Hello. In this chapter, we'll be going over the Chapter 18 summary slides, and we'll also be going over this handout here, which contains the important formulas that you need to know for Chapter 18. Both of these handouts are posted for you online. Let's take a look at the Chapter 18 handouts. So we'll start with the PowerPoint presentation. And in Chapter 18, we'll be going over cost, volume, profit analysis. So cost, volume, profit analysis asks the question, how many units do you have to sell to break even? Or it asks the question, how many units do you have to sell to make a certain amount of profit? So for example, let's say that I want to break even. Break even means that I'm not making money, but I'm not losing money. Basically, I'm covering all my costs. So you can see in this graph here that the break even is 1,000 units, and the break even is $500,000 in sales. Break even is when your revenue and your total costs are equal to one another. If you can sell more than the break even, you can see here you're going to have a profit. If you sell less than the break even, then you can see here that we're going to have a loss. So what that means is that there are two kinds of costs that you have to learn about. The first cost is called fixed cost. So you can see that fixed cost is this line here. It's a straight line. Fixed cost is always per unit of time. For example, fixed cost might be per month, or it could be something that's per quarter or per year. Fixed cost is always the same no matter how much you sell. Even if you sell nothing, you have the same amount of fixed cost. Even if you sell more units, the fixed cost is always the same. Examples of fixed costs would include something like monthly rent. Your rent is always the same no matter how much you sell or don't sell. The other cost that you can have is called a variable cost. Okay, so variable cost means that if you don't sell anything, you don't have any cost. But as you sell more, then you have more variable cost. So an example of variable cost would be, for example, bottles, if you make beer, let's say. So as you make and sell more beer, you have more bottling cost. So you can see that variable cost gets bigger as you sell more. So if we take fixed cost and variable cost and put them together, we have what we call our total cost. So you can see that the red line in the notes is your total cost. Okay, so total cost is the red line, and your sales revenue is the yellow line. So if you look at the graph here, what if we sell 600 units? Are we losing money or are we making a profit? You can see if we sell 600 units here, you can see that we're in this area here, we're losing money because the total cost line is higher or bigger than the revenue line. What if you sell 1,400 units? In this case, you can see the revenue line, sales revenue line, is higher, it's higher up, it's above the cost line, the total cost line. So you can see we're making a little bit of profit. So the most important thing to know is that you have two kinds of costs. So you can see we have variable cost and fixed cost. The way to tell is that variable cost is always per unit, like per haircut, for example, if you own a barbershop. Fixed cost is always per unit of time, for example, per month. Fixed cost is always the same no matter what. And this is called a cost, volume, profit income statement. So CVP stands for cost, volume, profit. So here we have sales of 800,000. So how do we get 800,000 in sales? We sell 1,600 units at $500 each. That's 800,000. We sell 1,600 units and the variable cost is $300. So that means variable cost is 480,000. Sales minus variable cost has a special name. It's called contribution margin. If you take your contribution margin and subtract out your fixed costs, that's called your net income. Okay, so remember, you have two kinds of costs in Chapter 18, variable cost, fixed cost. Sales revenue minus variable cost is called contribution margin. Okay, so what if you have your selling price minus your variable cost per unit? So here in this example, what if your selling price for one unit is $500? What if your variable cost for one unit is $300? Then you have what's called the unit contribution margin. So in this case, it's $200. That means that for every unit that I sell, if I only consider the selling price minus the variable cost, I have $200 that I'm making that's being contributed to my bottom line. Notice that here we have contribution margin, which is $320,000. That's like a total number. Here we have unit contribution margin, which means for one unit. In this case, for each unit that you sell, you make $200 towards your bottom line. Okay, so let's take a look at this example here. This is going back to the original example. In this example, what is the contribution margin? It's $200,000. In this example, what is the contribution margin per unit? It's $200. Is this company losing money, making money, or breaking even? This company is breaking even. The way that you know that is because net income is zero. So when you break even, your net income is zero. You're not losing money, so it's not a negative number, but you're not making money because it's not a positive number. Okay, so remember that the contribution margin per unit was $200. So in this slide, and in that slide, the only difference is that here you're making 1,000 units. So you can see at the top here, you're selling 1,000 units. What if you sell 1,001 units, like you sell one unit more? Then how much money do you make? You make $200. If I were to sell 1,002 units, then I would be making $400. So how do I know that? Because the unit contribution margin is $200. So for every unit that I make, I'm making $200 in extra money. You'll note that the fixed cost is not changing. It's always the same. So in this example, if I sell 1,001 units, the fixed cost is $200,000. What if I sell 1,000 units? The fixed cost is still $200,000. Okay, next, let's talk about contribution margin ratio. Contribution margin ratio is just a percent. So you can say that contribution margin ratio is 40%, or if you like, you can say 0.4. Okay, so 0.4. So how do you get contribution margin ratio? You take your contribution margin per unit divided by the selling price, and you get your contribution margin ratio. So 200 divided by 500 is 0.4, or you can say 40%. Okay, so here we know that sales minus your variable cost minus your fixed cost is going to be whatever your net income is going to be. Okay, so now the secret to this chapter is to know formulas. Okay, so here is something that is not in your book. These are all the formulas that you need to know. So if you know these formulas, then you can figure out all the answers in the chapter. Okay, so what you see on the screen is the most important part. Okay, so just a couple of things I want to mention. SP means selling price per unit. VC means variable cost per unit. And FC is just your total fixed cost. Right? So total fixed cost could be like $400,000, let's say. So if I take my revenue minus my costs, I get my net income. How do you figure out your revenue? Well, it's SP times U. For example, if the selling price is $5 and I sell 10 units, then my revenue, what is 5 times 10? That would be $50. How do you figure out your variable cost? You would need to know what it is per unit and multiply it by the number of units that you sell. Fixed cost is always the same. So if you take your revenue minus your variable minus your fixed cost, you get your net income. Remember, we talked about contribution margin ratio. Contribution margin ratio is, for example, 0.4, or you can call it 40%. If you're going to use these formulas for contribution margin ratio, use like 0.4, like use a decimal. So we have some formulas here. Break even means how many units do I have to sell to break even, or how much sales revenue do I have to break even. Target profit means if I want to make $10,000, for example, how many units would I have to sell, right? So what's the formula for target profit in units? Take your fixed cost plus the target profit, the amount of money you're trying to make, and then you divide by the selling price per unit minus the variable cost per unit. What does this formula tell you? Target profit sales. It means if I want to make a certain amount of target profit, if I have a desired net income that I want, how much sales revenue do I have to make it happen? Finally, margin of safety. Margin of safety means how much extra sales do I have over my break-even sales? Okay, so how much extra sales do I have? In this case, actual or expected sales, it's the same number. Okay, so it's called actual or expected sales, same thing, minus your break-even sales, that's your margin of safety. Margin of safety ratio is just a percent. It's saying like what percent extra do I have over my break-even? Okay, so let's take a look at this problem here. Okay, so we have the answer. So I'm not going to look at the answer, even though we already flipped to that slide. But it's saying, what is the break-even? It says, Gosselin Company is planning to sell 200,000 pliers for $4 per unit. Okay, the contribution margin ratio is 25%. 25% is 0.25. If Gosselin will break even at this level of sales, what are the fixed costs? Okay, so we can use the formulas here. Okay, so one of these formulas will always work, and sometimes more than one formula will work. If more than one formula is going to work, it's always going to be the top formula and then maybe one of the other ones down here. So here we need to look for clues. It's saying that if Gosselin will break even at this level of sales, okay, so if they sell 200,000 pliers at $4, that's the break-even level of sales. It's saying what are the fixed costs. Okay, so let's see which formula we're going to use. They're saying break-even, right? I see that listed here. I have contribution margin ratio, right? And let's look at the formulas. Which one has break-even and contribution margin ratio? The only one is this formula here. right? See, it says break-even sales, and then it says contribution margin. So we've got two things here. And then look at the question. It's saying, what are the fixed costs? This is like a gift. We have to figure out the fixed cost, right? So if we use this formula, we have everything except for the fixed cost. So let's do it. Here's the problem again. So we have break-even sales. So break-even sales. Okay, the formula is fixed cost divided by contribution margin ratio. Okay, I got that from right here. Break-even sales equals fixed cost over contribution margin ratio. Okay, so break-even sales, fixed cost over contribution margin ratio. Okay, so break-even sales. Okay, so sales is in dollars, right? If we were using break-even units, then it would be units. Here it's in dollars. So break-even sales, it says if they sell 200,000 pliers, they will break even at this level of sales. Okay, so what is the break-even level of sales? 200,000. We want these in dollars, so times $4 per unit, right? And that should equal fixed cost divided by contribution margin ratio. So contribution margin ratio is here, contribution margin ratio. Okay, so contribution margin ratio is 25%. So we're just going to put 0.25. Okay, so now we have 800,000 because 200,000 times 4 equals fixed cost over the contribution margin ratio, which is 0.25. Okay, so it turns out if you do the math, you're going to get 200,000. Okay, so $200,000. Okay, so the answer is $200,000. Okay, so you can see if we go back to the slides here, for this particular problem, the answer is $200,000. Okay, so the secret to this chapter, a couple things. The secret to the chapter is to be able to differentiate between variable and fixed cost. Variable cost is always per unit, like per haircut, okay, per haircut. Fixed cost is always like per month. And then you can use these formulas to get the answer. I posted the longer version of the PowerPoint slides, and also there's a lot of walkthrough lecture videos. So feel free to check those out and ask me if you have any questions. Thank you.